In the year 2000, two brothers inherited $50,000 each from their grandfather. The older brother bought a small rental duplex in a quiet suburban neighborhood. The younger brother put every dollar into a simple stock index fund and never touched it again. Neither brother checked in with the other for 25 years. When they finally compared notes, one of them had built a portfolio worth millions, while the other had built something just as valuable but completely different. Both had grown wealthy. Both had made the right choice. And yet, if you asked either brother which investment was superior, they would give you two completely opposite answers. This is the debate that refuses to die. Real estate versus stocks. Landlords versus shareholders. Bricks versus tickers. And by the end of this video, you will finally understand which one actually builds more wealth, and more importantly, which one is right for you. Walk into any online forum, any dinner party, any group chat about money, and this argument is always simmering beneath the surface. Real estate investors will tell you that stocks are just numbers on a screen, vulnerable to panic and disappearing overnight. Stock investors will tell you that real estate is a slow, expensive, illiquid headache disguised as an investment. The truth is that both sides are partially right, and both sides are partially blinded by their own experience. A landlord who bought property in the right city at the right time will swear real estate is the only path to wealth. A stock investor who rode the market for 30 years will insist index funds are unbeatable. The reason this debate never ends is simple. Both investments have created millionaires. Both investments have also created financial disasters. The difference is rarely the asset itself. It is almost always the investor holding it. Real estate investing means owning physical property with the goal of generating income, appreciation, or both. There are several ways to do this. Some investors buy rental homes and collect monthly rent from tenants. Others buy properties, renovate them, and resell them for a profit. Some simply buy land or commercial buildings and hold them for decades, waiting for value to rise. What makes real estate unique is that it is tangible. You can drive by the property. You can touch the walls. You can improve it with your own hands or hire someone to improve it for you. This physical nature gives many investors a sense of control that a stock certificate simply cannot replicate. But real estate also comes with responsibility. Tenants may stop paying rent. Roofs leak. Water heaters break at the worst possible moment. Property taxes rise every year regardless of whether the property is profitable. Real estate is not something you buy and forget. It is something you manage. Stock investing means buying small ownership pieces of publicly traded companies. When you buy a share of a company, you're not just betting on a stock price. You are betting on thousands of employees, factories, products, and decisions being made every single day to grow that business. Most modern investors do not pick individual stocks. Instead, they buy index funds, which bundle hundreds or thousands of companies into a single investment. This means that instead of guessing which single company will win, you own a small slice of the entire economy. Stocks require no maintenance, no tenants to manage, no toilets to fix. You can buy a share of a company in seconds from your phone while sitting on your couch. This simplicity is exactly why stock investing has become the default choice for millions of everyday Americans. Numbers do not lie, but they do require context. Over the last century, the stock market has historically returned an average of around 10% per year before inflation, based on major indexes tracking the largest American companies. That means, historically, money invested in stocks has roughly doubled every 7 to 10 years when returns are compounded. Real estate, meanwhile, has historically appreciated at a slower average pace nationally, often between 3 and 5% per year in raw property value. On the surface, this makes stocks look like the clear winner. But here is the twist. Almost nobody explains properly. Real estate returns are frequently calculated using leverage, meaning the investor only put down a fraction of the purchase price using a mortgage. When you calculate return based on actual cash invested rather than total property value, real estate returns can rival or even exceed stock market returns in strong markets. This single detail is the reason so many real estate investors believe their asset class is superior. And it is also the reason so many stock investors believe that comparison is misleading. Both are technically correct, depending on how the math is framed. Imagine a woman named Sarah who buys a rental property for $200,000. After her mortgage, insurance, and property taxes, she collects $300 per month in pure profit. That is real cash flow deposited into her bank account every single month, regardless of what the stock market is doing. Now imagine her friend Daniel, who invests the same amount into dividend-paying stocks. Daniel might receive a similar income stream through dividends, but historically, dividend yields on major stock indexes have often been lower than typical rental yields, especially in growth-focused markets. This is where real estate earns a reputation as the ultimate cash flow machine. Rental income tends to feel more predictable and tangible than dividend payments, because tenants pay rent whether the stock market crashes or soars. However, cash flow in real estate is not guaranteed. A vacant property produces zero income while expenses continue. Stocks, in contrast, never call you at midnight because a pipe burst. Every investment carries risk, but the type of risk looks completely different between these two assets. Stock market risk is fast and visible. In 2008, major stock indexes lost roughly half their value within months. In 2020, markets crashed nearly 30% in a matter of weeks before recovering. Watching your portfolio drop that quickly can feel devastating, even if history shows markets eventually recover. Real estate risk is slower, but can be more brutal when it hits. During the 2008 housing crisis, home values in many American cities fell dramatically. And because most homeowners used leverage, some lost significantly more than their original investment. A property purchased with only 20% down can wipe out an investor's entire equity if prices fall sharply. The psychological experience also differs. Stock losses appear instantly on a screen, tempting investors to panic and sell. Real estate losses unfold slowly, sometimes over years, which can create a false sense of safety even while the investment is quietly losing value. Neither asset is risk-free. One risk is loud and immediate. The other is quiet and delayed. Liquidity means how quickly an asset can be converted into usable cash. Stocks are among the most liquid investments in the world. You can sell shares in seconds and typically have cash in your account within a couple of business days. Real estate is the opposite. Selling a property often takes weeks or months, involves inspections, negotiations, agent commissions, and closing costs that can eat up 5 to 10% of the sale price. Imagine an emergency expense suddenly appears. A stock investor can log into an app and access cash almost immediately. A real estate investor may need to take out a loan against the property or wait months to sell, all while continuing to pay the mortgage, insurance, and taxes. This difference matters enormously for anyone who values flexibility or anyone who might need access to their money on short notice. Leverage is the single most powerful and most dangerous tool in real estate investing. Banks will happily lend you 80% of a property's value, meaning you can control an asset worth 5 times more than your actual cash investment. If that property appreciates by 10%, your return on your actual cash invested could be closer to 50% before expenses. This is exactly how many real estate investors build wealth faster than they could with cash alone. It is also why real estate has created more self-made millionaires historically than almost any other asset class in America. But leverage cuts both ways. If that same property drops 10% in value, the investor's actual equity could be cut in half or wiped out entirely. Leverage magnifies both gains and losses, and countless investors learned this lesson painfully during the housing crash. Stocks can technically be leveraged too through margin trading, but this practice is significantly riskier and far less common among everyday investors, which is why leverage remains real estate's signature advantage. If leverage is real estate's superpower, true passivity is the stock market's superpower. An investor can put money into a diversified index fund, set up automatic monthly contributions, and never think about it again for decades. No tenants, no repairs, no phone calls at midnight, no property management. Consider a teacher named Michael who invests $400 every month into an index fund starting at age 25. He never picks individual stocks. He never times the market. He simply keeps investing through every crash and every recovery. By the time Michael reaches 65, assuming historical average market returns continue, that consistent habit alone could realistically grow into a portfolio worth well over $1 million without him ever managing a single property. This is why stocks are often called the ultimate wealth-building tool for busy people. Real estate rewards active involvement. Stocks reward patience and consistency. Both assets offer surprisingly powerful tax advantages, just in different forms. Real estate investors can deduct mortgage interest, property taxes, maintenance costs, and depreciation, often reducing taxable rental income significantly, even while the property continues to appreciate in actual market value. Stock investors benefit from long-term capital gains tax rates, which are typically lower than ordinary income tax rates as long as investments are held for more than a year. Retirement accounts like 401k plans and IRAs can further shield stock gains from taxes for decades. When it comes to inflation, both assets tend to act as protection, but through different mechanisms. Real estate values and rents typically rise alongside inflation, and fixed-rate mortgages become effectively cheaper to repay over time as the dollar loses value. Stocks also tend to outpace inflation over long periods, since company revenues and profits generally rise alongside prices. Neither asset is a perfect inflation hedge, but both have historically outperformed simply holding cash. There is no universal winner here because there is no universal investor. Someone who enjoys hands-on projects, doesn't mind occasional stressful phone calls, and wants to build wealth through active involvement may thrive with real estate. The tangible nature of owning property combined with the power of leverage can accelerate wealth building for someone willing to put in the work. Someone who values simplicity, has limited time, and wants a truly hands-off approach will likely find stocks far more suitable. The ability to invest automatically, diversify instantly, and never deal with a single tenant makes stocks the more forgiving choice for beginners. Beginners with limited capital also face a practical reality. Real estate typically requires a large upfront investment for a down payment, closing costs, and repair reserves. Stocks allow someone to begin investing with as little as a few dollars, making it far more accessible to someone just starting their financial journey. Neither path is wrong. The right choice depends entirely on your time, your capital, your risk tolerance, and your personality. Here is the truth: most influencers on either side rarely admit. This was never actually an either-or decision. Many of the wealthiest investors in America hold both real estate and stocks simultaneously, using each asset to balance the weaknesses of the other. Real estate provides leverage, cash flow, and tax advantages. Stocks provide liquidity, diversification, and effortless growth. Think back to those two brothers from the beginning of this video. The one who bought real estate built wealth through leverage and rental income. The one who bought stocks built wealth through consistency and compounding. Neither made a mistake. They simply built wealth through two different engines. A thoughtful investor doesn't have to choose a side in this debate at all. They can start with whichever asset fits their current situation, then gradually build a portfolio that includes both, capturing the advantages of each while offsetting the weaknesses of both. So which investment actually builds more wealth? Real estate or stocks? The honest answer is that both have built extraordinary wealth for millions of Americans, and both have also disappointed investors who misunderstood the risks involved. The real determining factor was never the asset itself. It was always the discipline, patience, and knowledge of the person holding it. The smartest investors don't treat real estate and stocks as rivals. They treat them as two different tools in the same toolbox, each one useful for a different job.